Right now, across the globe, wealth is moving in a continuous, invisible web. Millions of transactions are processed every single second, forming an interconnected financial system of a scale that is almost impossible for the human brain to fully process. To put hard numbers to it, according to the Bank for International Settlements, the foreign exchange market alone sees daily turnovers exceeding $6 trillion. That is $6 trillion changing hands every single day. Look at global equity markets, and the numbers scale up even further. By the end of 2023, the total value of shares quoted on the world's stock exchanges surpassed $109 trillion. But behind these massive numbers is a very simple economic reality. Capital that just sits idle in a vault does nothing to advance society. It doesn't build roads, it doesn't fund research, and it doesn't create jobs. An individual citizen might only need to save a few $100s a month for their retirement. But a local government trying to modernize its infrastructure needs billions to build housing, transit lines, and power grids right now. Without a reliable way to take that idle savings and route it directly to the organizations that desperately need capital for immediate investment, the entire global economy would grind to a halt. The financial services sector provides that vital link. It operates on three distinct, non-negotiable pillars that work together to keep civilization moving forward. The first of those pillars is the investment chain. Think of it as the main bridge between savers with available money and the businesses and governments that require funding. The chain pools funds and allocates capital toward the most profitable investments, raising global productivity. When this chain runs efficiently, funded enterprises produce goods, expand operations, and generate returns for the original savers, improving a nation's global competitiveness. But allocating capital is only half the equation. Once the money is moving, it has to be protected. That requires the second pillar, managing risk. Every day, global enterprises face a barrage of highly unpredictable threats. A localized climate event, a major industrial accident, or a sharp currency fluctuation can easily bankrupt an unprotected corporate business. To prevent that, the financial system provides tools like specialized insurance and sophisticated derivatives. These financial instruments act as a shock absorber against global volatility, insulating operations from catastrophic losses. If you remove either the investment chain or this risk management layer, the constant threat of total financial ruin would paralyze corporate planning. Businesses simply wouldn't take the risk to innovate. The third pillar is the payment system. These practical, daily mechanisms ensure money can be transmitted, managed, and received with absolute reliability. At the highest level, this involves international networks like SWIFT. By enabling financial institutions to exchange information securely across borders, SWIFT standardizes and stabilizes the flow of global trade. But while high-level international mechanisms handle corporate trade, localized technological innovations are actively restructuring developing economies from the ground up. Look at Africa, where simple mobile phones are providing secure online banking services to vast populations who previously had no access to traditional bank accounts. Access to these digital accounts allows individuals to capture and protect surplus income that was previously difficult to manage. By providing a secure place to accumulate these funds over time, the system enables a transition from day-to-day survival toward long-term planning for education, family investments, and future leisure. Reliable payment systems break down geographic barriers to capital. They serve as a powerful engine of financial inclusion, democratizing access to the global economy for individuals who were previously locked out. When you evaluate global economic disparities, the wealth of a nation is frequently dictated by the sophistication of its financial system. This chart compares the depth of financial markets in the United States against those in Europe. As you can see, the American markets maintain significantly deeper pools of available private equity and venture capital. That extra market depth is exactly why the United States experiences larger, more sustained increases in productivity. The availability of that capital allows for a much faster pace of industrial innovation and a higher rate of newly registered patents. Researchers at the Federal Reserve Bank of San Francisco analyzed exactly how these markets influence long-term economic performance. They found that well-developed financial markets efficiently direct the flow of savings, which directly facilitates the accumulation of capital and the rapid production of goods and services. The financial sector provides a diverse array of products and instruments, perfectly suited to the intersecting needs of both borrowers and lenders,
keeping the overall economy balanced. The financial services sector acts as the bridge between current resources and future potential. By continuously channeling idle capital into productive projects, it provides the essential machinery that transforms dormant savings into the tangible expansion of the modern world.